Okay, so this will be the last part, so this is part 5 of topic 3, and we're going to continue our example from the previous topic, and we're going to use the transaction analysis worksheet to create financial statements. So just recall the transactions that we had, so they're the ones that we used, and then we recorded those into the transaction analysis worksheet, and that's where we left off at the end of the last mini lecture. So you can see from here we've got our accounting equation, assets equal to liabilities plus owner's equity, and we've totaled it all up. So we know what the total for each of our assets are, we know what the total for our liabilities are, and we know what our capital is. So from this information we can create financial statements. Now the 3 financial statements that we're interested in doing is the income statement, the statement of changes in owner's equity, and the balance sheet. Okay, so looking at the income statement, so we're just going to assume that our transactions were for the month of May. So we're going to head it up, because financial statements have headings. So we're going to head it up Expensive Designs Limited. So the first part is the name of the company. The second line of the heading is what the statement is. So this is an income statement, and it's for the month of May. Now the income statement simply calculates the net profit, and we know from the previous studies that our net profit is made up of revenue minus expenses, and that's the format that it takes. So from our transaction analysis table in the income statement column, we know that our service revenue is $1,800. So under revenue we're going to put service revenue $1,800, and then we're going to expand that to say less expenses. The only expense we have at the moment is advertising. So advertising expense of $200, total expenses is $200. The profit is calculated by taking the revenue minus the expenses, so the net profit for the month is $1,600, and that agrees with the total in our income statement column on the transaction analysis worksheet. Okay, so that's our first financial statement. The second thing that we need to prepare before we can prepare the balance sheet is we need to complete the statement of changes in owner's equity. So again, it has a heading. So we head it up with the name of the entity, Expensive Designs Limited, and this statement is the statement of changes in equity for the month of May. Now for this one, it tells the story of what has changed in owner's equity during the month. So what's happened in this month is the owner has contributed $10,000 and the company has made a net profit of $1,600. So that $1,600 comes from the income statement. So this is the link, this statement, if you like, is the link between the income statement and the balance sheet. So the information that we calculated, and I'm just going to flick back, the net profit for the month of $1,600, that is the figure that drops down into the statement of changes in equity for the month of May, $1,600. We can add those two together and subtotal it, so $11,600. Less the dividend that they paid. So remember I said in the previous part that dividend is a return of capital, so it's part of owner's equity, but it's a reduction in owner's equity. So less the dividends of $400 gives us capital at the end of May, $11,200. If we go back to our transaction analysis worksheet, if we add the capital plus the income statement together, $9,600 plus $1,600, we get the capital at the end of May, which is $11,200. Now it's this figure here, the $11,200, that is the link between this statement and the balance sheet. So the information is flowing through the 3 statements. Now balance sheet is simply a physical representation of the accounting equation. Again, it has a heading, Expensive Designs Limited. It's the balance sheet at the 31st of May. So it is a snapshot of assets, liabilities and owner's equity as at a particular date in time. We start with our assets and we can take these straight off the transaction analysis worksheet. So cash in the total column, in the total line for cash is 4,800. Accounts receivable, and I've just shortened it there to REC, so the balance sheet would fit on the one slide. So it's 1,100. Office supplies, the total under office supplies is 500 and the motor vehicle is 5,000. We total our assets and that's 11,400, which agrees with the total under the assets columns in our transaction analysis worksheet. Okay, the other side of the balance sheet is our liabilities and owner's equity. So we've got our liabilities is accounts payable of $200 and our owner's equity is the amount coming down from our statement of changes in owner's equity, so 1,200. Remember I said that's the link between one statement and the other. Total owner's equity and liabilities is 11,400 and the two equal. So you can see that our balance sheet is just simply a physical representation of our accounting equation. Assets on one side are equal to liabilities and owner's equity on the other. So just an overview and some comments. If you think about using a transaction analysis worksheet for large firms like McDonald's, David Jones, JB Hi-Fi, would that work? Okay, so if you think about all the transactions that any particular McDonald's outlet would have in one day, would it work to record the transactions in a transaction analysis worksheet? No. This type of analysis is not appropriate for large numbers of transactions. Okay, it becomes unusable. It's all right for us to use as a tool to teach you how to analyse transactions, but unless the business entity is a really small one, it doesn't work very well for firms with large numbers of transactions. So instead what they use is journals and ledgers are used to record the accounting information, and they usually do this by ways of computerised accounting. Okay. The accounting recording process typically follows these steps. The transactions happen and they are recorded on source documents, so invoices, checks, bank transfers, etc. These transactions are recorded in the journals. The journals are then posted to the ledgers. From the ledger we make a trial balance, so we just pull all the balance out to see whether our ledger is in balance, and then we prepare our financial statements. In addition, instead of an analysis using plus and minuses, as we've done, an accounting system uses debits and credits. Now, I really don't want you to know this. I am just giving you this information as an explanation about how things work in the real world. For our purposes, I want you to know how to use a transaction analysis worksheet. So as indicated earlier, for this course you do not need to know how to prepare journals, ledgers or trial balances, and you can ignore those pages of Chapter 4 in the textbook. There is no assessment on journals, ledgers, trial balances and debits and credits. Okay, so to summarise topic 3, we learnt that business transactions involve arm's length exchanges of resources between two entities. The accounting equation expresses a relationship between the assets controlled and owned by the entity and claims on those assets, so the liabilities and the owner's equity. And typically we write the accounting equation as assets are equal to liabilities plus owner's equity. Every transaction or every business transaction has a dual effect, so it affects two or more accounts. And for our course, you need to know how to analyse transactions using the transaction analysis worksheet, which I've shown you in the example. In practice, accounting information can be captured using journals and ledgers and debits and credits. And that is the end of topic 3.